Hey everyone, Paris Jackson here, aka Benny's dad, back with another video for you guys. It's been a while, and figured it was a good time to come back. Today is Quad Witch, one quarter down in the fiscal 2025. Have some updates for you guys, and really, I am taking the channel in a semi-new direction this year. I'm gonna be doing a lot more just historical "What have I done" videos. Still going to be doing the trading. I'm still doing that on a regular basis. So no worries there. Still definitely have trading videos for you. And then we'll also be doing book reviews and that kind of nature. So if you like all that stuff, please like, subscribe this video, share with some friends. And today's video is going to be, how I built my first $10,000 portfolio. So I know, we all want to get to that $1 million number, $2 million, $10 million, whatever your goal is. And we all have to start somewhere. I recognize that, a lot of the times people want to give advice for, hey, if you have, X amount of dollars, do this with it, or whatever the case may be. And oftentimes they skip over, what it actually looks like to build, a $10,000 portfolio. And so I wanted to share my journey and what it took for me to build my first $10,000 portfolio in this video. We'll get into some other, screenshots. I have brokerage statements for you guys, so you can see exactly how I was invested, how I split it up, what my contributions were, and what that looked like for me. So just to give you some background, I graduated from San Diego State University in 2016. I had about $25,000 in student loan debt, and really just took the time from 2016 to 2019 to attack that viciously. And it was the great race to zero, right? Like I was racing to a zero net worth, which sounds funny, but like when you're in debt, that's kind of the best place to sprint to, is getting to zero, meaning that you have no consumer debt. I was 25 at the time, so I had no mortgage, no wife, nothing like that, no car note. I was driving an old 2008 Honda Civic that I purchased from my mom for $2,000. And really, it wasn't until September 2019 that I started my investment journey. And I'll go into this later at the first book review that's going to be dropping in a couple of weeks. So I don't want to spend too much time on it. But basically, I had no idea how to invest in September of 2019 when I started this portfolio. But I knew that I wanted a Roth IRA for the tax purposes. And I also wanted to have a little bit of diversification. It made me stick to ETFs. So as we go through this, you'll see kind of my investment journey. And my goal is to do, my 10,000 portfolio, 20,000, 30,000, 40,000, 50,000, 100,000, and show you along the way, how I changed as an investor. And ultimately, were those changes actually beneficial? Did they pay off? Or was it better if I would have just stuck where I was at? So stay tuned for all of that in this video. And we'll go ahead and get to the presentation now. So going through my first 10K portfolio, I want to first just touch on the contributions aspect of this. So as you can see, this is my brokerage statement from August 31st, 2020. I was 99.8% in stocks. I had a Roth IRA, right? And this was the very month of August where it crossed over into that 10K space. As you can see, on July 31st, 2020, I only had just shy of 10K. And then, at the end of August is where I really got over the 10K mark. And then these were the holdings at the time. So VNQ was a real estate index ETF. I had been told, hey, real estate is definitely where you want to go and put your money. And then I had VYM, which is a high dividend yield ETF comprising about 50% of my portfolio. And then I had about 30% of my portfolio just in the total stock market. So very, very I think vanilla beginning investor type of setup. And I think actually this is great for anybody that wants a little bit of diversification, as well as just wants a really strong, kind of well-rounded portfolio that's going to produce income, right? That was my thought process when I started this portfolio, is that I really wanted to focus on, being really diversified. So I was only in ETFs. I didn't know much about stocks themselves. And I really wanted a dividend, right? Because I thought the dividends would basically reinvest themselves, a 3.53% yield, as you can see here, $192 being generated in annual income that's just going to build upon itself. And I wasn't paying attention so much to the growth of the underlying ETF, but I was really focused on dividend investment income, right? And not till much later did I realize, the two, you could have a really great dividend paying stock that doesn't grow anything, that underperforms a stock with a worse dividend, but has the growth in there. So just to give you an example, just off the top of my head, AT&T, right? People love it because it's a 7% dividend stock, right? Like, oh my God, 7%, it's really high, it's unheard of. But the stock itself has fluctuated between $15 and $30 for the last 20 years. So even though you have that consistent 7% dividend coming in, you don't have any growth. Whereas, a company like Apple might only produce a 1% or 2%. 2% is really generous. It's more like 1% annual dividend, but the growth of Apple has been so much that it's become obviously one of the biggest growth stock names of the last 20 years. Same for Microsoft or Nvidia or any of those other companies. Growth is actually going to impact your overall portfolio more so than a high dividend would be. But I didn't know that. I didn't know that at the time. So I built this portfolio with the thinking that, hey, it's going to be a high dividend yield. Now, the question is, well, how did this perform against, say, the S&P 500, right? I think that's a great question, because you obviously want to measure any portfolio against the S&P 500, right? Because the S&P 500 is the market. It's the 500 largest companies in the US, right? It wants to, if you cannot beat that through an arrangement of investing, then you're better off likely just investing in the S&P 500 for growth purposes. So there is a website called Portfolio Visualizer, which I'm pulling up now, and I plugged in the data that I just shared with you in terms of, hey, look, this is what the portfolio looked like at the time. I was 30% VTI, 17% VNQ, and then 52.7% in that BYM high dividend yield ticker, right? And then I go to my settings here, and you can see that I did from August 2020, which is when I took the screenshot of that brokerage statement, through this most recent month. I had $10,000 and I was contributing $500 on a regular basis. So hit the Analyze Portfolios button here. And you can see that from a portfolio return standpoint, had I kept this very same portfolio through the close of this most recent month of February, so this does not include anything in March, but you can see that it underperformed the S&P 500 by about 2%, cumulative return of 80.46% versus a cumulative return of 94.34%. So that's 2% on an annual basis that this underperformed the S&P 500. And you can see, some of the more stats here. Zoom in a little bit. That the starting balance of this portfolio ended at 58,742 versus S&P 500 being at 62,746, which doesn't sound like a lot, but if you look at this rate of return on an annual basis, annualized CAGR 47.15% versus 49.29%. It's obviously a huge difference. Now, these numbers are obviously inflated because they include the money that you're adding in, so it's not a true growth of that. If I wanted to customize this and take away the cash flows, we can see the true growth of, hey, if I had not invested another dollar, what would that look like, right? So you're 13.75% versus 15.6% over that same period of time, which is significant. I mean, if you plug in to an investment calculator, later, go through, I have this pulled up kind of, as we do this, but let's say you take that 10 grand, and at the time I was 25, so I had 40 years to contribute at a return rate of 13%, 1.3 million, that's really good, right? But if I bump it up to 15% on an annual basis, and over that same time period, we're talking about 2.6 million, which is a 20, or not a 20, it's a 100% difference between the two, right? Like if I go 13%, which is what we were getting on this, which is actually 13.75. So let's be a little bit more specific here. 13.75%, the ending balance is 1.7 million, right? Which is really good. I think you can definitely retire with 1.7 million. Having $10,000 turn into that over the course of 40 years is really great. 13.75%. It's a little higher than average returns for the S&P, but compared to the 15.6% that you would get, just invested in the S&P over that same period of time, you're looking at 3.3 million versus the 1.7. And once you adjust for inflation, 3.2 million is a lot better than the 1.7. So this portfolio, unfortunately, while good enough, underperformed the overall market and was not something that I should have stuck with. And granted, in later videos, stick around to see what I actually do with my portfolio. But you can see the growth of these over the years, thanks to Portfolio Visualizer, right? We're still underperforming. Let's add the cash back in so we can see that. 500, inflation adjusted, yep. Okay. Scrolling down here, this was very interesting to me here, in that the annual returns, most years the S&P 500 outperformed this portfolio that I had created, right? 2022, it was close, less than 1% better. 2021, 0.5% better, right? 28.33 versus 28.75. 2022 actually drew down less, but then 2023, was pretty substantially better return for the S&P 500 than it was for the set portfolio. And same thing for 2024, almost 7% better. Obviously these 2 years were pretty great years for the overall market, and not in one where you'd want a defensive portfolio. That being said, this most recent year, the overall market is only up 1.4%, where this portfolio would be up nearly 4%. So in 2025 and 2022, when we're having a bit of down years in both of them, this portfolio has a better defensive structure than a straight S&P 500 portfolio would. So that is very interesting to me, right? That's interesting to me that the returns would be worse most of the years, but your drawdowns would be in such that, for this 2022 year, I mean, the drawdown was half, a little less than half, right? 10% versus 18%. But when we're in the game of compound interest, it very much matters. Obviously, the growth years, you want them to do very well. And in 2020 and 2021, they were almost identical, very close. Obviously, 2023, 2024, they kind of got blown out the water. But in the down years are where, this starts to make sense. So I don't think I would use this portfolio today, but it's definitely something for, me to consider later in life, right? Like right now, I'm in a capital accumulation phase of my life, meaning that I want to accumulate as much capital as possible to, grow my wealth as much as possible over these next few years. Whereas, in my twilight years, in my late 50s, 60s, I might switch over to a portfolio like this, with the high dividend income, some diversified real estate, the overall stock market still being in there, but just a smaller, 30%. Maybe even introduce some bonds to, smooth out some of this and preserve the wealth. But right now, I think that, the overall appeal of this particular portfolio just isn't really there because of the difference in investment returns over the long haul, right? Over the long haul, it's going to behoove me to invest just in the pure S&P 500, or a different portfolio if you pay attention to, a coming video. But right now, it just makes sense to invest in the S&P 500 versus this original portfolio. Now, I didn't know then what I know today, but at the same time, there's still value in that portfolio I had created, and to look back and see how it did versus how I'm doing today, and use this knowledge at a later time and date when being, a little bit more defensive versus being more aggressive is going to be more beneficial in my life, which is going to be my twilight years. So hopefully this video helped you guys, in your own journey. One thing that I did forget to mention and show was I did contribute $9,700 to build this original portfolio. And it was completed from September 2019 to July of 2020. So if anybody remembers what happened in March of 2020, we got a huge correction in the market, basically a crash, very short crash that recovered, and the overall year did well. But anything that I had put in basically had crashed, and then I was buying back in for just a few months of that correction. So, having to contribute so much before I get gains in 1 year, is likely. So if you're on your own journey of building a 10K portfolio, just keep adding, and before you know it, you're going to look up and you're going to have that 10K portfolio. Now, if you're unable to contribute $500 a month like I was able to, that's okay. If you can do 400, 300, 200, 100, doesn't matter. The important thing is that you pick an asset allocation that works for you, and pick an amount that works for you and contribute to it on a regular basis. So, in the later video, I'll be showing, my 20K portfolio, 30, 40, 50, all the way up, and how I built it and how it performed year to date, or month to date, or to this day, however you want to slice it. And I hope you enjoyed this. Leave a comment. How did you build your first 10K portfolio? And if you're still building it right now, how are you building your 10K portfolio? What are you contributing? What's the hurdles that you're running into? And anyway, I hope you enjoyed this video, and come back for the next one. Bye.